there has been some serious animal spirits in this market for a long time, but let's just focus on the last like 6 weeks or so. What's the effect in what you do in equity issuance? What's the demand takedown?
Look, across the board on the IPO calendar and the follow-on calendar, converts, everything across the board in terms of the ECM product is working. SPACs are working. The IPOs that have priced so far this year up over 40%. Every single SPAC that's priced this year is up, trading above issue price. And so it's a really strong market across the board.
Well, Kristin, doesn't that mean, with SPACs especially becoming so much of the volume here, is there too much money with nowhere to go?
Look, I think you're seeing investors really piling into the front end of the SPAC because they're working. I think the expectation is that even from the investor side, even if 20 to 30% of the SPACs didn't find an acquisition, at this point, the returns are strong enough because of the aftermarket trading of the ones that are finding acquisitions that's kind of getting modeled into the way that investors are thinking about participating in SPACs. And we're actually seeing investors that typically hadn't participated in the front end of a SPAC forming new strategies to participate in the SPAC IPO.
Well, speaking of SPACs and IPOs, we know what the immediate calendar looks like. There's a lot going on. You just saw BUMBLE really looking to raise more money here. What does your pipeline look like?
I would say that especially in the tech side, companies that had initially kind of thought that they were going to go public even in 2022 are accelerating plans to at least be prepared to go public this year. There is such a strong bid for growth equity for tech IPOs, and part of that's driven by, looking back at the last 5 years, the private capital markets have been so strong. So there have been a number of companies that could have gone public for years that have stayed private. And so now you can see the kind of pent up demand from the growth investors manifesting themselves in the performance of some of these IPOs, especially the high growth tech IPOs. And they're raising less capital as a percentage of the market caps of the company. So there's a liquidity dynamic where there's kind of a supply demand imbalance happening in the market because they're coming to the market so well capitalized from the private funding events over the last several years.
Kristin, I'm curious, is there a line in the sand, and let's maybe talk here about the VIX, where companies decide or advisors say, you don't want to go forward with this? Around GameStop, we saw obviously volatility spiking really quite sharply. I'm curious to know what impact that has in the way that this process unfolds.
Well, I guess there's two things. One, you can't really underestimate the power of social media these days. And I think a lot of the hedge fund models, didn't have necessarily hadn't factored in the kind of power of retail, especially this day and age when so many people are, trading from their phones, trading from home. There's just a much greater influence, I think, from the retail side. Nothing's changed in terms of fundamentals. And so if from the hedge fund kind of orientation in some of these stocks, it was much more of a liquidity play. And so what does that mean for issuers? I would say, for companies especially companies that have been impacted, being prepared to take advantage of any kind of increase in liquidity, because that's really paramount. You saw a number of companies announce at the market programs and be able to sell stock and in the heightened liquidity. In terms of your question on the VIX, I would say there are ways. Companies are raising capital through high periods of volatility, kind of consistently, and there are ways to, even in an IPO context, to de-risk the IPO with things like having an anchor investor on the cover of the prospectus. Even if volatility does spike again, the VIX spikes, 30s, 40s, et cetera.
Well, one thing you had mentioned to me once is what this means for the amount of power that a company has that's going public, right? Everything from governance to the lockup periods. How much are companies asking to chip away at this, given how much success they are having, regardless of not having that protection?
Yeah, look, I think in the last year, we've seen a ton of innovation around structures, mechanisms of getting public, things that have been tested in the past, but really now there's much more willingness from the buy side to accept things like a modified lockup structure, early lockup releases. I think the days of the kind of standard 180-day lockup are dead, because now there's just such a more such a bigger focus on liquidity. And so having a more measured way of getting liquidity into the market after the company does an IPO actually makes sense and is better for the investor ultimately. And so I think there are a number of innovations that have happened in the last year that will persist in the post-COVID world as well.
So if I just kind of take a moment and thread some of the needles here, I mean, we're rethinking early lockups, lots of demand for SPACs, more IPOs, taking advantage of kind of the retail liquidity, et cetera. That all doesn't sound so great. I mean, what's going to be the tipping point for at some point this just comes crashing down, and like who's going to be on the hook for that?
I mean, as long as the IPOs, SPACs continue to work. I mean, IPOs are up over 40% this year. As long as these offerings continue to work, I think we'll have a strong bid for it. There could be some more discipline that comes into the market if you see some of these companies, miss their earnings estimates kind of 1-2 quarters out of the box. Then you can see kind of more discipline from the investor side of bifurcating between, certain companies. But for now, it seems like, really everything's working.
Kristin, do you think SPACs are a phenomenon that would only work in the United States? They work very well in the United States thus far. Is this something that could be replicated elsewhere?
Yeah, I think with the right regulation, just making sure that they have kind of a similar structure to what is allowed in the U.S., I think that it absolutely can be a global phenomenon. I mean, SPACs have been around for a long time, but they've really gained popularity in kind of mainstream recently. And it's a product that that will continue to be, a mechanism of getting public in the capital markets. Maybe not with the same exuberance that there is today. I mean, there've been, I think 118 SPAC IPOs so far this year and 36 regular IPOs. I don't think it maybe doesn't end up being that high of a percentage of the IPO calendar, but it will continue to persist. And I think it'll be a global phenomenon. It makes a lot of sense for companies that are either, capital intensive businesses that can de-risk the investment, thesis by raising a bunch of capital up front. It works really well for private equity backed businesses where the, sponsor may want to sell a significant percentage of the company at the IPO. Or for storied stocks that have, kind of a 3, 4, 5 year really acceleration in growth or massive ramp, and they can tell that story and put projections into the proxy statement versus an S1 process where they can't.
It wasn't that long ago where we saw these companies, when they filed for an IPO, you'd also sit there and say, okay, are they looking to sell themselves too? With how well these companies are trading, is that kind of dual track option starting to be a lesser of a consideration? Are companies more saying, hey, maybe it's not so bad to be owned by a bunch of day traders?
Yeah, I would say, the dual track is always a consideration, I think, especially in technology. But it's been less of an attractive option, I think, just given the valuations of public companies, especially growth companies in the software space in particular.
What sectors are still pretty popular right now? I mean, usually I tend to hear healthcare and certain areas of technology. Is that what you're seeing as well?
Yeah, I would say biotech, software, payments within technology are some of the sectors that people are pretty focused on. Vertical software in particular has had a pretty strong bid.
And in terms of the macro drivers of this process, Kristin, we spent the morning talking about the reflation trade. We seem to spend a lot of mornings at the moment talking about the reflation trade. How connected is what you're doing and the reflation trade? What's the overlap on the Venn diagram?
Yeah, and I think because of kind of the reflation trade, it's causing investors to really have to be weighted in equities, and so even more so than we were a month ago. I think that that's causing even further demand.
So I want to go back to Alix's question, too, on what can cause us all to really get upset, right? You were saying volatility's no matter, almost, right? So what is it, then? Is it higher interest rates? Is it what can really stop the rally here? What should everybody be concerned about?
Look, I think if the biggest risk is just companies not meeting what they said they were going to do, and investors having kind of a misguided view on how visible some of these business models are. And so, if that's really what's propelling some of the super high valuations, 30 times plus revenue multiples, is just the visibility that these companies have. And so, if that goes away, or investors lose confidence in that, that's where you could start to see, kind of a reversion to multiples of the last 10 years versus where we are today.
Well, that's so interesting too, because there's a lot of bubble talk out there, right? So what you're saying seems that it's not too far off, that concern, that really retraction of the multiples here. Is it something that you see as more imminent?
Look, I think if you look over the last 10 years, let's talk about the highest multiple, kind of software companies, for example. If you look over the last 10 years, companies traded at an enterprise value to revenue to growth multiple, the equivalent of like a peg on a revenue multiple of closer to 0.4, 0.5 times. Today, they're trading kind of on average 0.7, 0.8 times, with recent IPOs trading at 1 times plus. And so could you see things kind of migrate back? Possibly, but the business models today have a lot more visibility is key, right? And they have a lot more visibility in their kind of next year, 2-3 years out, because of the nature of some of the contracts. So as long as that continues, I think people will pay, higher multiples for some of these companies.
So these valuations you see from your investor demand that they will continue for some time?
It seems that way. Certainly seems that way.